Hi, and welcome all of you to this webinar on top 10 learnings from WNI insurance policies placed in 2022. Thank you all for dialing in. Before we start on to dive into the topic, let me introduce our very exciting panel here for the discussion. On my right, you have Alexander Hammer. He is the M&A manager for emerging markets in AIG. Prior to his AIG stint, he has held various roles in insurance firms both in London and Australia. He has been involved in underwriting WNI policy deals across Europe, Asia, and Australia. On my left, I have Cameron McCoy. Cameron is a seasoned underwriter working with the Beazley M&A team with a primary focus on Indian warranty and indemnity insurance risks. Prior to joining Beazley in 2020, Cameron worked as an M&A underwriter with another major insurer in London, and was also, prior to that, working as a corporate lawyer at Clifford Chance and Baker McKenzie. On my right, again, I have Mandira. Mandira is the managing director of Marsh India Insurance Brokers Private Limited. Mandira joined Marsh in 2014 to lead their PE and M&A practice with a specialized focus on transaction risks. And lastly, I have Radhika Parekh. She's a leader in the warranty and indemnity insurance practice group at NDA and has extensive experience in advising underwriters on WNI deals, particularly which have an India focus. I am Harshita Srivastav. I co-head the M&A practice at NDA, and I also head the WNI vertical, where we at NDA, specialize and we focus in advising underwriters from across the globe in terms of placing policies which are India focused. I think with this, let us get into the topic, and let me just set some context for this discussion, for the discussion this afternoon, in terms of why, what is a WNI policy and what are we, what is the interesting nuance that we're discussing in this discussion today. Just for the benefit of the audience and to go down to the very basic, a WNI policy basically intends to cover for risks which arise due to losses which may be suffered either due to a breach in warranty or losses which are attributable to risks or events which existed prior to the giving of the warranty, either at signing or in closing. Typically, in a transaction, in a standard M&A transaction, while the commercial objective of the parties is aligned in terms of deal close, the interests of the buyer and the seller are not always aligned. Typically, a buyer demands a broader set of representation and warranties from the seller, and the seller is always seeking to restrict its exposure post-closing to a limited and highly qualified set of warranties, so to say. One way to bridge this gap is to have a WNI policy in place. A lot of advantages, and before we go on to the advantages, two basic forms of policies that we have seen in our experience. One is buy side and the sell side. As the name suggests, the buy side policy seeks to cover the buyer as the insured party, whereas a sell side policy seeks to cover the warrantors or the sellers as an insured party. Coming to the advantages, and advantages vary from both sides of the table. From a seller side of it, look at an exiting PE investor situation where the PE investor is looking at a clean exit. And obviously, as with having a limited fund life in mind, it does not want to take over enormous indemnity obligations on itself, and which is where a WNI policy really acts as a good recourse for the buyer as well as the seller. Flip the sides of the table and you look at it from a buyer's perspective, where let's say he's entering into an unknown jurisdiction. The primary objective that a buyer would really look at would be to mitigate his concerns in terms of seller credibility, or let's say the unknown risks that may be associated to the business he's getting into. And that's where I think a WNI helps in securing the interests of the buyer in terms of a buy side policy. The ultimate objective, obviously, in both cases is to ensure that any uncertainties or any risks are foreseen and within the deal and are covered for, and do not hamper the risk appetite of the parties and do not hamper a smooth closure of the transaction. Looking at what our experience in the last few years has been, obviously it's a direct, the uptake of the policy is directly proportional to how to the M&A deal activity happening. So last year, I think in the last few years, we've been seeing a general increase in the uptake of the policies, with a little or a slight decline, particularly in 2022. I think with that we saw some sectors which had which showed up better in terms of again direct function of the M&A activities. So healthcare, CMT, renewables, etc., took the lead when it comes to when it comes to sectors where we have seen there was a larger interest in policies. With the average deal size actually increasing in 22 to 331 million in 22 versus a 253 million in 21. I think with this and keeping in mind that the trend is growing across sectors with the M&A activity being a little relatively buoyant in India. I think I'll hand it over and, to tune in. And this webinar will offer an exciting opportunity to all of you to tune into different perspectives of the parties which are engaged in an underwriting process. We have a broker, we have the underwriters, and we have the lawyer. So with this, I'll probably, direct my first question to Mandira. In terms of how have you seen, Mandira, in global markets, plus how have you seen India shaping up when it comes to WNI policies?
Thanks, Arshita. So, like you rightly said, global M&A has been on a rise. I think last 2 years we saw a big rise in the M&A transactions globally. I think especially 21 and the first half of 22, and India was no different. And what we've been able to do in this process is that to emphasize the penetration of the product, India actually did more number of deals than anywhere else from an insurance perspective across Asia. So India was at the top of the leaderboard across Asia with the maximum number of WNI deals, which sort of chimes into what Harshita said, that there's been greater penetration and uptake of the utilization of the product. Again, the average deal size increased in the last couple of years, which is perhaps coming out of the fact that a number of controlled secondary transactions that happen. And the average across deals, we saw that about 20-25% of the deals got insured from a limit perspective of the deal size. Of course, this is subject to what is the overall deal size of the transaction. If it was $1 billion plus deal, we perhaps saw about 10-ish% as the limit being taken, versus say a $500 million deal, we saw about 25%. But you're right. I mean, there is general acceptance of the product across sectors. Yeah. We saw, and we saw more number of insurers, therefore looking at India actively. And I guess Alex and Cam, perhaps you guys have seen a lot more India activity over the last few years.
Yeah, definitely. I think one point to note is we're seeing the product expand to a really broad array of industries. So I think in the past year, we've done deals in renewables, healthcare, pharmaceuticals, manufacturing, retail, tech, infrastructure. So really across the whole gamut, of different industries where there's been M&A activity. So I think that's been really encouraging and something we've definitely seen in the last sort of year.
Yeah, and it shows the sort of appetite insurers have across sectors, right? Depending on whatever is the season or the flavor in terms of the the hotter sectors. We've seen insurers get comfortable with those sectors and provide insurance across the board.
Yeah,
we'll touch some of those sectors later, but I think from a market perspective, we definitely feel India has been very strong over the last sort of 24 months, and I think they're not feeling economically the same sort of inflationary pressures that you're seeing in Europe, in America, and as such, the deal flow is remaining quite strong. But then to add into that, you've also got an increased penetration, increased understanding of the product coming from sort of PEs and corporates here, lawyers here as well, meaning that the product is becoming much more widely used, such that we're seeing, despite deal flow maybe down, we're still seeing increased policy count sort of going up year on year.
Absolutely.
Yeah, I think that that's a very interesting phenomena we able to notice as lawyers on the table, that this was a rare phenomena in terms of and possibly only some of the larger deals were taking it at least a few years back. Last 2 years we've seen more and more deals, even if they're smaller in deal sizes, that they're looking actively at a policy here. Radhika, do you have anything to add to in terms of your view of the market last year?
Yeah, no, absolutely. What you said, Harshita, is a very good point, that 5 years ago, 6 years ago, it was more or less the larger deals that were interested in WNI. But I think as insurers also getting more comfortable with the India market and the policies being able to cover more, it's actually driven the adoption of these policies a lot more recently.
That's right, and I think that's exactly why and taking us to the key question of this session, which is what are the learnings that we've seen because of the massive increase in policy uptake, particularly in the last 2 years, I would say. Are we do we have a list of learnings from, from all of your perspective, from an underwriter perspective, from a broker perspective, and from a legal perspective, we'll chime in terms of what can, the market learn from the deal learnings that we've had. So, Cam, you want to start with the, what has your experience been?
Yeah. I mean, I think one key learning is that the earlier that the W&I is baked into the deal process, usually the smoother it goes and the better it results ultimately for the client. So, where that is particularly pertinent is in the scoping of diligence. So essentially, at its core, the policy will cover areas which have been subject to a reasonable diligence process. And so as such, when a buyer particularly is scoping out its diligence, which is, often quite early in the deal process, it's really helpful for them to have in mind the sort of areas that they're going to be looking for coverage for under the policy. So, I mean, I think, Harshita, you're going to speak later in a bit more detail around coverage of title to property. But for example, if they're looking, if the buyer's looking for cover for title to property, then the insurer is going to expect a specialist title report, to evidence that for us to be able to get comfortable to cover it. Similarly, if it's an IP heavy business, then we're going to expect sort of quite a lot of diligence going to intellectual property and perhaps IT and matters like source code. When you're scoping out financial DD, like if you're looking to warrant certain accounts, we'll expect the financial diligence to cover those accounts. So I think when mapping out the scope of diligence, it's very useful to have in mind not only the key areas of cover, but also what warranties am I actually asking the seller for? Because ultimately the insurer will ask, wherever it's pertinent, what diligence have you done to try to independently verify this warranty and not simply rely on a seller representation? And sort of, I think an additional thing from our perspective, from insurers' perspective, is we like to see some negotiation between the seller and the buyer. And I guess it's key for us that we see that the seller's engaged in the process, because ultimately, these warranties are about information asymmetry. And it's important for us, the seller who knows the business, even if we're happy for them to have very, essentially nil liability under the SPA, and that's what the policy allows for. But we do want the seller to be involved in the negotiation, and so we're comfortable that they're disclosing adequately and turning their mind to the veracity of the reps and warranties that they're giving. I think one final point to note from our perspective is, whilst it's useful, definitely useful to get W&I involved early, as I've said, if there is any particular matter which, for time pressures or for whatever reason, the buyer hasn't been able to diligence properly, then that needn't hold up the transaction or the policy from our perspective, because we are quite happy to look at that after the policy's been bound. And then we can also cover areas by endorsement, which is something that, insurers do quite a lot.
And that's very helpful, I think, Cam. And maybe from there, we can go to Mandira to understand, from a broker standpoint, what do you think has really, possibly helped deals run more smoothly in the year, and which possibly could be a lesson for the audience?
I mean, I think the one takeaway I can see from what Cam's saying is that insurers are getting more and more comfortable with India. I think the fact that these insurers have been doing Indian transactions for 5-7 years at this point. So they've got, they understand local issues. They understand, what coverage is needed in India, how the processes are run, how to make sure that the process is run effectively. And that's the great thing, that the market is no longer new. The product is no longer new, and it's part of the process, right? And what's happened is the penetration has gone up, of course. More and more from being just, a private equity driven product. It's a widely accepted product, in India. And that has driven both wider coverage, like Cam was mentioning, but also more number of insurers entering India. And what that has helped us do is get better pricing across sectors. Obviously, depending on what the sector is, regulated, unregulated, the pricing would vary. But generally, the pricing has gone down in the last couple of years. In the sense, this year it has gone down because there was a big increase last year because of the increased uptake in M&A and limited capacities available. But now with more insurers coming in, we've seen the pricing has gone down and continues to go, better pricing for the clients. And the other thing is, even from a retention perspective, retention is the self-retained risk, it's like a basket in an SPA, what needs to be, retained by the client, by the insured. That number has also gone down. It used to be majority 1% of your enterprise value, and we used to sometimes 0.5% of EV as the retention, but now we regularly see that the retention is quoted at 0.5%. And that just shows both things, the insurers getting more and more comfortable with India, understanding Indian risks and therefore providing lower self-retained risk per se. So that's one trend that I'm definitely seeing shaping up in India. And I think that also boils down to the fact that the sectors and, across the board have been, what Cam said has been acceptable. So I think you've seen a lot of deals, some of the trickier sectors, and you guys have had the appetite to do those deals as well.
Yeah.
Absolutely. We've definitely seen an increased number of deals happening in regulated sectors, and regulated sectors have always been a bit more of a challenge for insurers because you've got more things to trip over, more regulation. And I think everyone on this panel here will understand that India can be regulation on steroids to an extent. So working through that has always been a bit more difficult for insurers. But we've insured in the last sort of 12 to 24 months NBFCs, healthcare, pharma, renewables, all of which are very regulated industries here in India. And so that appetite from insurers has increased. And also I'd like to think buyers are now more comfortable investing in those in those industries as they get their own understanding, but also knowing there's an insurance policy that can sort of help them with that investment into those regulated industries. And so, for us, it's definitely about understanding those regulations and having the experience in India to be able to work through each of those individual sort of sectors specific regulations. And I definitely think that's happened in the last 24 months. That increase in that has sort of helped our own sophistication with these deals in the last sort of 12, 24 months.
Yeah, and I think not just the supply, the insurance capabilities, insurance capital that has increased, even the demand has increased, right? And this has come around not just because of the private equity funds and larger deals and secondary deals happening, but we're seeing an increase in the corporate utilization of the product, which means corporates are using these insurances to invest and divest, their assets. And I think that's a big change from what we had seen earlier. In fact, we were looking at our stats, and last year we did 2x the number of deals for corporates than the year before that. And I think that's there to stay. And this is all coming down to the fact that there is a visibility of the product. Corporates know about the product and understand that, having an insurance in place, even though they might have the balance sheet to take the risk on, it's better to transfer that risk to a company that is in the business of paying out claims to an insurance company rather than having that risk on their own books. And I think that's the other trend that I'm seeing in terms of, the client usage.
Yeah, I think that's a very interesting point. Taking a cue from the last bit that you mentioned, Mandira, I think we've also had a lot of clients who, reached out in terms of deal, and while they are still evaluating a deal, I think their risk appetite also generally is now, increasing towards deal, which, as Alex mentioned, towards heavily regulated sectors from a buyer standpoint, also because they know that there is a product which is available in the market. Yeah. So I think it's overall becoming it's also the other way around where, deals are also happening because they see that there is an uptake in policy, the insurers are becoming comfortable. Yeah. So perhaps we can go stretch a little further up and do this deal. So I think, Cam, anything to add on that?
Yeah. Well, I mean, one example of that and the insurers becoming more comfortable is so sort of certain matters such as cyber, which would previously never be covered under a W&I policy, in certain circumstances now can be covered. And I think sort of it goes back to sort of what the policy is there to do essentially, and what the policy isn't really there to do is to stand in place of a sort of market standard normal other insurance policies which should generally be bought for a specific industry. An example of that might be cyber insurance for certain businesses. But if we're comfortable with the business, if we feel like there's been good diligence of IT security systems of the business, and if we review the cyber policy and we think it's adequate, then the W&I policy can actually sit in excess of that. So providing additional cover for cyber or for matters such as product liability or professional indemnity, in the right circumstances. And I think that can be a sort of an additional benefit to the policy.
Yeah,
that's right. Radhika, anything, and while we talk about flexibility of the insurers, I think we also have seen from a legal standpoint that the insurers are going, further and beyond in terms of providing coverage for positions specifically, which were the ones we saw as a general exclusion or a specific exclusion a few years back. So anything that you want to add on that from our perspective?
Yeah, absolutely. So we, about 4 or 5 years ago, typically 281 risk was not coverable, was not insurable. 281, just for the benefit of our audience, being Section 281 of the Income Tax Act, which essentially says that any transfer of securities that takes place while there is a pending proceeding will be deemed void. So the transaction itself would be void if there's any income tax proceeding that's pending. And that was not an insurable risk at one time. But more recently, we've seen that insurers are comfortable insuring, this risk as well, subject to, of course, getting some sort of opinion or memo from the tax advisors saying that there are no pending proceedings. So that's also, and I think that's attributed to what everyone's been saying, is that insurers becoming more comfortable with the Indian market and, more penetration of the product itself.
And I think what to add on to what Cam was earlier mentioning on title, for example, that's another classic example where we did see land and title being excluded in policies at least a few years back. And last year, with while doing deals which were RE heavy, particularly like renewables and infrastructure deals, I think the insurers are now getting comfortable with covering for title. Obviously subject to a proper diligence being undertaken on the asset, and some specific issues being if some specific exclusions if required. But I think the comfort level has generally increased there from an underwriter standpoint, because RE and land title was always an issue which was very country specific, and India as a country, given the kind of risks associated with land title, I think it was always a deemed exclusion for all the insurers until the last few years, when we are now seeing a change. Anything that you want to add, Alex or Cam, on that?
Not on the title to land piece, Cam, unless you had anything, but I could touch on maybe some of the other things that we're starting to see and sort of talk a bit about how the policy is evolving with the warranties that are sort of coming up. I mean, historically, we for a long time saw that sellers were really only giving annual accounts warranties. So fixed it, for India, that's 31 March 2020, 31 March is the end of the year. And, they're the audited accounts and that's what you get. But if you're doing a deal in December or even January, you've got a very long period there between when the audited accounts were given and a lot of operation of the business that's not being picked up by accounts warranties. So we've seen buyers request and sellers give management accounts warranties, which would be a set of accounts for that period between the last audited accounts and a signing date, and they're obviously not going to be subject to audit. And so that's always been a bit more of a challenge in terms of coverage from an insurance perspective. However, as that request has come up more and more, we're seeing our ability to cover those warranties more and more. And importantly, when thinking about covering those warranties as an insurer, we need to understand what are those accounts. Every company might do their management accounts differently. They might do a quarterly full balance sheet and P&L, or it might just be a monthly P&L. So understanding what those accounts are, understanding they're not going to be the same as the audited accounts. They're going to be subject to year-end adjustments that aren't there, possibly audit adjustments as well. So we need to understand that there's going to be a difference, and then seeing that the buyer has done appropriate due diligence into those management accounts, and the way in which they've been prepared is going to be key. And lastly, I think remembering that the audit account should be one set of warranties and the management accounts are separate set. They shouldn't be held to the same standard because they're two very different things. But over the last sort of 12 months, we're starting to see that on Indian transactions more often, that interim accounts cover, and we're definitely being able to find solutions for that for clients, which I think is a testament to the Indian market sort of developing and increasing that sophistication around the product.
So along those lines, just kind of getting back to other types of warranties that insurers are now getting more comfortable covering. We've also seen that the business warranties in relation to labor compliances, everybody's aware that India has kind of a very sometimes convoluted regulatory framework or statutory framework governing labor law compliances. But as insurers have become more comfortable with these statutes, and as there's a greater understanding of what the actual monetary liability is, which is fairly low in a lot of cases, subject to the sector and how many employees are employed by the target, there's a lot more flexibility in covering these labor-related warranties, even if perhaps maybe there hasn't been the most robust diligence, simply based on having a greater understanding of the statutory framework of labor law compliances. But there is one thing to note on this that, India is coming out with a new labor code, which does have increased monetary penalties for non-compliances. So it'll be interesting to see once that code is implemented, how, if at all, that affects insurers' comfort with respect to covering these labor warranties.
I think as a broker, I can tell you that the coverage that the insurers are willing to offer is increasing. And just picking out the points that were just spoken about, Section 281 is a fundamental, it falls within the fundamental warranties. And in SBA, we spoke about title to land, which also is a fundamental, warranty. And what we're seeing now is there's an increase in the request for larger limits, up to the deal values now for fundamental top-up, right? Which wasn't the case earlier. And I think it is to do with two reasons. One is a number of funds are reaching an end of fund life, and there's always a question about how to make a clean exit, how to wind up the fund if they are required to give a fundamental warranty for 7 years or perpetuity, depending on what the negotiations are up to the deal value. And the second reason is, again, coming back to the point that the pricing in general has gone down, and therefore the fundamental pricing has also gone down. It makes a lot more transactional commercial sense for clients to take that additional cover of the full fundamental top up rather than just taking a 20-25% number across all business, tax, and fundamental coverage, because it sort of falls within the transaction cost. It's pretty commercial. And so we are seeing a general increase in the ask or to get a top-up coverage for fundamental warranties. And that's being provided by insurers on a regular basis now. So that's the other thing, which sort of comes from the points that, coverage is expanded and therefore the limits requested are increasing as well.
And there's capacity in the market for that fundamental top-up. There's enough capacity to sort of fill up.
Absolutely. In fact, I think for $1 billion deal as well, I think we should be able to get that full capacity between various markets across the globe. So absolutely, I think, and at a pretty commercial price.
So I think overall, to sum up, point two in terms of our learnings, I think the key point that we are all driving home is that with the insurers getting more comfortable with the Indian market, with obviously a lot of deal activity happening, which is being covered or underwritten by the insurers across the globe, and with AIG and Beazley obviously topping up the market share in terms of being the largest market share drivers in the Indian market, particularly with I think more than 63% or around 63% of the market share in India is driven by the players. I think the point that we are seeing and with which we are arriving at is that there is a lot of excitement. There is flexibility in terms of from an insurer perspective to cover deals, large or small, irrespective of sector, and so that trend probably is here to is only likely to grow from here, and that's where we are. That's where we sum up point number two. Moving on to the next question, because and again directly taking it up, because there's a policy uptake generally happening, we will see we are likely to see a surge in claims. We are all hoping we don't, but if as and when we do, and because AIG and Beazley come up with experiences in different markets and not just India, how is it that you really see a claim process running at the back end for you guys, and what has your experience been? What are the sectors in which, what are the warranties which generally are are being triggered? Is it legal? Is it fundamental? Is it tax?
Yeah, maybe I can touch and give some
Sure.
background. So AIG has been running this business globally for a very long time, and so has a very long claims history, and they sort of put out a report every year, or not last year, but every year before that, we've put out a claims report that sort of talks about some of these points. And I think it would probably typify the claims by an increasing number of frequency. We've sort of gone from a notification on 1 in 6 policies to 1 in 5 in sort of the last 2 to 3 years. But more importantly, an increase in severity. We're seeing the claims that are being paid are being far bigger and far greater, such that I think from our last report, the average cost of a material claim being any claim over $1 million, the average was $20 million claim payment. So we're talking, significant numbers here, such that, it really is a severity-based product, right? We're talking, really high numbers. So if I think about, where these claims are coming from, our data is showing us the majority are coming from the accounts warranties. So 34%, I think, is probably the biggest. Tax makes up similarly about 30%. And then material contracts make up a very big portion of the material claims, i.e.
That's
ones that
interesting.
big,
Hmm.
big sort of numbers. To Ken, maybe you want to touch on these.
Yeah, I mean, we would echo that. We're also seeing notifications on around 1 in 5 policies. Globally, I think we have something in the order of 150 open claims, being worked through the process now. So I think insurers like Beazley and AIG, we're set up to pay claims. We have dedicated M&A claims people. So yeah, we really have sort of the expertise. And one thing I'll say about the claims process is similarly to getting W&I involved early. The sooner that the insurer is involved, from our perspective, in the claims process, the better outcomes we tend to see, both for us and for the insured. So really, if you're ever think that there might possibly be a breach or there are circumstances which might lead to a breach, we really like to know that as soon as possible, and then we can work collaboratively to work out sort of how we get to a to the best solution for the insured for that. Going on from that, I know that Marsh, I think Mandira and Marsh have dedicated claims advocates, right? And then I'll let you sort of speak on that, but from our perspective, getting the broker involved is also really helpful because they understand how claims work, and they're sort of fundamentally different from if you were suing a seller, for instance, for a breach of warranty, because this is essentially, the policy is set up for claims and the approach is fundamentally more collaborative. So the broker can help talk you through that, and to help you understand that the more information that the insurer has, the quicker they're able to sort of come to a solution for the claim.
Absolutely. I mean, I think the one advice we give our clients all the time is over notification is better than under notification, which means if you think there is any situation, any circumstances which could potentially lead to a loss under the policy, potentially lead to a breach of a rep, even if you're not entirely sure, let's notify the insurance company, right? We, like Cam said, we have a dedicated claims team, dedicated W&I claims team. So what we do is we work with the clients. We know in which form this needs to go to the insurance company to notify them of a potential, loss. And we work with the client, with their advisors to present the information in a way that the insurance companies can then process it quicker. And again, this is a very collaborative process, right? I think eventually all of us are on the same side. The idea is to provide adequate information to the insurers so that they can review and come to a conclusion on a particular breach. And I think it's it cannot be said enough. And that's why we're seeing an increase. I mean, in India, I can tell you we're seeing an increase in the notifications of losses because clients are understanding the process. I think it takes a bit of time for even the insureds to get savvy to understand when they need to announce that there is a claim, right? And I think that comes with over time. That comes with using the product more, and we're seeing year on year that India has a number of claims. I think tax tends to be a big part of our claims in India. Tax breaches, and I think absolutely.
Mandira, just on tax, we've also seen that in India. And for example, right now we're working with and supporting the insured on a $40 million tax claim, us and other insurers.
That's right.
And we're working with the insured, as that goes through the process of adjudication and dealing with the tax authorities. But the point is that the insurers we're standing alongside the insured right from the process from the beginning, which might also include the payment of interim payments, which might have to be made, and also the defense costs. So.
Absolutely. In fact, the reason probably why tax claims are more is they're third-party claims, right? You get a third-party notification, you get an income tax authority notification, an audit. And so there is a potential loss that can happen, and which probably is one of the reasons why there's an early detection of a claims loss which is related to tax vis-a-vis some of the other losses which are to do with financial statements, where you need to investigate the situation to know that there is a breach in one of the financial statements, for example. But yeah, we are seeing claims now across the board on transactions in India. And I think given that we're doing more and more policies, we expect to see more claims, over the next few years.
Alex, anything to add on that?
No, just to echo the thought that we are seeing an uptick in notifications for India specifically, and it's a function of the deal volume
deals,
having
yeah.
grown, the sophistication
Yeah.
of the product having grown, the number of people using it, the understanding of how to make a claim has all increased. And
Increased.
there's generally a bit of a lead in time to claims. I mean, AIG's data shows that claims are generally around that 18-month period after closing.
Yeah.
So you're really, given there could be 6 months between signing and closing, you're really talking 2 years after you do the deal
Yeah.
that we're thinking about claims coming through. So we're definitely starting to see that now with the volume that was at sort of end of 2020, 2021. They're now starting to play through in claims. So it's going to be important to sort of work through those with the clients here, but it also has weight to the value of the product because it's it's clearly there and responding to claims.
Absolutely. And I think just to extend on that point, we need to, or the client needs to notify the insurance company of a loss within the policy period, but that doesn't necessarily mean that the actual loss needs to happen within the policy period. So for example, our general warranties are covered for 3 years, and that's because the statute of limitation in India is 3 years. Now, as long as we've notified the insurance company within the 3-year period of a potential loss with respect to a general warranty breach, even if it takes you 4, 5, 7 years before the actual loss happens, the policy will still respond to that notification because the notification was made within the policy period. And I think that is why it is so important to notify the insurance company on day one of knowing that there can be a potential claim, so that once it's notified, it doesn't matter how long it takes. It's an actual loss policy. The loss needs to be suffered by the insured, but it doesn't matter when the actual loss happens as long as the notification has happened within the policy period.
That's very interesting. I think from a legal standpoint, we've also seen a lot of tax claims which have, which have been raised by different insurers, which have been received by different insurers and where we are working on. And I think as Mandira and as Cam was mentioning, I think the key is just passing off on the information that, or the notification on time, because what we've also seen is that more or less the companies and the sellers or the buyers in different cases are piling on information because before they hand it over to the insurer or their counsel. At the insurer's level also, there has to be a lot of analysis which has to go in terms of analyzing whether there has been a breach or not, if there has been a breach, whether it crosses the de minimis, etc. So for that, I think a very important point that Cam raised, that the notification from the side of the insured has to be very prompt, so that the insurer can then take on its own process, run the timelines, etc. And I think the other key point here is that right from the start of the policy policy negotiations up to the claims process, it's very collaborative in nature, the whole process from an insurer standpoint, and it's less adversarial, so to say, like how we see in transactions, and more collaborative. So I think that's another interesting point in deals when we are underwriting, because from all the parties are aligned in terms of the objective, and I think the idea is to get the best out of it.
And an insurer doesn't have an emotional connection to the target, a seller
Correct.
might, right? So they don't want to admit that anything went wrong with that business, whereas we're sitting here objectively and can see
Yes.
a warranty has been breached. So definitely, I feel like it's more collaborative.
More collaborative.
Also, it's a very reputational product, I think, because it's an M&A product where insurers are giving coverage to an M&A deal for clients who will perhaps use it on the next deal as well. I think the repeat usage of the product is extensive. Like once a client has used on a particular deal, clearly which shows that it adds value, they literally use it on the next deal or consider it on the next deals at least. And therefore, if these claims aren't paid, then the viability of the product will go down, right? And the same client is not going to use it again. So we typically talk in our offices that, it's a very, very reputational product. And therefore, I mean, these are large policies that are taken, and therefore the claims experience in general in the product has been very good for our clients.
That's interesting. So this is on a more frequent product, if I could say, in terms of transactions that we see a W&I insurance policy. But are there other, Mandira, and maybe you can add, are there other transactional risk products that you're seeing that are, that the parties are looking at, or the parties are now opting for, given there is a lot of appetite now amongst the players to go for insurance?
Absolutely. So I think one product which is very, very well accepted and used in India is tax insurance.
Yeah.
It's actually been done in India for 10 years plus now. Marsh has been placing these policies. And therefore, I don't think any other country across Asia does as many tax policies in India. And I think that boils down to the fact that the policy is there to cover any ambiguity of law or interpretation of law. And which means that if the client has chosen a particular tax treatment about a particular tax event, and they feel that there can be a challenge by the ITA, by the tax authorities on the treatment that they have adopted for that particular tax situation, they might want to consider a tax insurance policy to ring fence that particular situation. unlike a warranty indemnity insurance, which is there to cover an M&A transaction and all the reps and warranties which are there in the SPA, a tax insurance policy, on the other hand, is a specific policy which is done to ring fence a particular situation, and therefore the policy will define what the loss can be. We've done several of these policies. They could be to do with, India, Mauritius, DTT that we had until 2017, India, Singapore, Netherlands, Cyprus. These are various treaties that we have with these countries about where the place of effective management poem lies for the seller and whether they need to pay taxes in India. We actually have a double taxation avoidance treatment with these countries, agreement with these countries. And therefore, but the ITA might come back and question on where the permanent establishment lies for a particular seller. That's an example. We're doing more and more stuff on the domestic tax risks as well, GST being one example, where again, there can be a question around ambiguity on a particular situation. So these are some of the examples. The insurers have dedicated tax underwriters, and that just means that they have better understanding and appetite for Indian tax, and therefore, I only see an increase in the utilization of tax for various things, various tax issues over the next few years. So that's on tax insurance.
Land, I think, is another one that is picking up, right?
Exactly. So that was the next thing I was going to come. It's relatively new in India, but land title insurance is another very specific insurance that we've started doing in India. As the name suggests, it's there to cover issues related to land title. Now, of course, if there's an M&A transaction in real estate, we always ask this question: should we take a WNI policy or should we take a land title insurance policy? And the difference is the M&A insurance or the WNI insurance will obviously cover not just the land title, but around business and tax. Whereas a land title is not an M&A insurance. It doesn't need to be taken when there's an M&A transaction happening. It can be taken at any time as long as you're looking to cover for any third party, claims on a particular land. Of course, anything which is known through diligence, which has come out in the title report, that does not get necessarily picked up by the policy depending on what the issues are. But generally, those policies are taken to cover a particular risk related to title to a particular land parcel. So that's the other product that we are seeing, still relatively new, but that's something which we are seeing being used more and more in India. And I think the only other one product that I can think of here is contingent risk. As the name suggests, it's a specific risk policy, a contingent situation, things which are already litigious, maybe things which are heightened risk. An example can be in an SPA, you might see specific indemnities. Now, those are things which are known heightened risks. And we can look, or rather explore, whether an insurance is available or not. I'm sure Alex and Cam can chime in. It's a tough product to do globally because it relates to a specific known issue. But those are things that perhaps can be explored depending on case facts, case merits of that particular situation. And I'm hoping we'll see more and more the increase in appetite from insurers with respect to this risk. But that's one understood product that perhaps can be related to an M&A.
It's difficult because everyone is going to be different. There's no sort of common theme of contingent. And so each one relies on the facts of each specific issue. So appetite is often limited because they can be very high risk issues. So they need to be worked through, but there's no reason, we can't consider the facts of any one thing and see if it's something that fits within the appetite and sort of do that through the broker.
I think you can consider tax policy as a contingent risk as well, because that's also covering a known specific situation that we're trying to ring fence. So we are in that sense doing it. I guess we just need to expand it outside of tax to cover other sorts of issues.
Other sorts of transaction risks. Yeah,
absolutely.
Yeah. So an example of contingent risk we might place, we have placed globally, is particularly around where there's been a piece of litigation and then there is an appeal. So it's already been through one round, of judgment in relevant court, and then we can often look at that and sort of protect, I guess, protect some of the downside risk in that scenario for the appeal, on the basis of legal opinions, provided by the bias counsel and also our own diligence.
Yeah,
but it is very much a case by case.
That's true.
That's interesting. So I think that sums up the discussion. Thank you all of you for sharing your views and insight into the deal making from an underwriter, or deal making in terms of a WNI insurance policy, if I can say. For the benefit of the audience, I'll actually repeat the 10 learnings that all of us shared in the course of this session. The first one being involving the insurer early on in the deal, and the scope of diligence or the SPS scope to be in line with the policy as much as we can. Second is cyber being looked at more favorably now from an insurer's perspective. Third is increase in the number of insurers, and the little slowdown in the M&A activity has also contributed to reduction in pricing and retentions. Fourth being an uptake in ask for fundamental top-ups.
Yeah.
Fifth is an increase in number of corporates who are now taking up the policy as compared to PEs, which is how we were seeing the market being driven at least till a few years back. 281, again, insurers getting more comfortable covering for Section 281 issues. Seventh is title to property, which is now subject to diligence and specific exclusions. Insurers are okay covering for it. Eighth is labor. So in terms of specific labor issues and subject to the headcount and the penalties involved, the insurers are flexible, I would say, to cover for specific risks coming therefrom. Ninth is audited financials and the whole the comfort around covering for unaudited financials or the period which is outside the audited financials. And the last one being covering for heavily regulated sectors like infrastructure, like renewables, etc., where we are seeing more and more deals being underwritten now. So this is what we have for the afternoon today. I hope you guys, have, could draw some interesting insights from this session. We'll now open the floor for questions from the audience.
How is the IT Section 281 risk addressed in the light of the fact that the IT Act can be amended retrospectively?
Yes, so I could touch on that. Traditionally, you would see it in an SBA, and if it's not in the SBA, you would see a limitation on changes in law retrospectively, and so there currently isn't a solution for that right now, because it will be caught by that change in law post closing. So currently, not a solution, but worthwhile thinking about.
Sure. I think the second one is, does the RBI allow for an insurance company to pay the claims of a buyer in case of a cross-border M&A buyer or seller being in India?
So let me take that one. I think I don't think I'm completely understanding the question, but perhaps where the insured party is, who is the insured under the policy document, will determine which insurance company we will use to get that transaction insured. And therefore, if the insured is an Indian buyer, for example, we will have one of the Indian insurance companies. For example, AIG has, of course, their India partner here called Tata AIG, and we would work with them to have that policy insured with Tata AIG, and therefore there would be no question about FEMA or any challenges in paying out the claims. So eventually, as a broker, that is our job to make sure that we have the right entity insuring a particular insured depending on the legal domicile of that entity.
Okay. Yeah. So moving to the third question by Dhruv again, it is where there's an escrow account which is created between the or exists between the buyer and the seller, which allows for an immediate release of payment. How is the payment triggered? Is the insurer the first port of call? So Cam, you want to take that?
Yeah, I mean, it's going to depend on how the escrow is structured under the acquisition agreement. But I mean, essentially, what would be most logical is that the escrow could either be the first port of call, following which the insurance will be set to sit in above that, or the escrow could sit above the insurance limit if that was required. But I mean, the real benefit of the policy is that it enables the escrow to not be required at all, because there's a recourse straight away to the insurer.
And also, don't forget, escrows can often have a 1 year time limit on it, and the insurance will cover, as we noted, 3 years for general warranties.
Yeah,
7 years.
tie up to the time
So,
to the limitation.
Yes, that was one of the original reasons the policy was so popular. Was the ability to sort of do away with an escrow and replace it with the insurance. But yes, depending on how clients want to go about it, the insurance can either sit in excess of an escrow or sit as a first port of call instead of the escrow, or escrow could be used for specific indemnity matters possibly as well.
That's right. I'm not
I think the last question.
Yeah,
is
this
on
is
tax.
the tax insurance. Yeah.
Yeah.
So the last question is by Prasad. It says, will that cover only any possible contingent risks arising out of tax laws and not any other law, say FEMA or foreign trade?
So again, like I mentioned, tax policy will define what the laws that it covers, right? It is not a policy which is a general tax policy to cover any tax situation. It is there to cover a particular tax defined loss. And therefore, whatever that loss that gets defined, that's what the policy will cover. No, it will not cover anything which is outside of what gets defined under laws, and whether that has an implication from any other laws that might pertain to it.
Yeah, but I think in terms of touching upon whether it will cover a FEMA or a foreign trade, I think we've not seen foreign exchange laws being captured for the purposes of, as Mandira is saying, as captured for the purposes of tax policy. The tax policies will cover particularly the tax laws, as the base of it.
Correct. Eventually, whatever situation that you need to get covered, there needs to be comfort from Big Fours around and with an opinion on the matter, right? And
Yeah.
typically there are different levels of opinion that gets that's provided. The highest level of opinion is called a should level opinion. So whichever fact, and perhaps if it's not tax laws and other laws, it'll probably fall under the contingent risk, what we just discussed a little while back. But irrespective, the insurers would need to see an opinion from, say, a law firm or a Big Four opining on that matter and having a comfort of a should level, which is the highest level of comfort, before they can tell you whether this is something insurable or not. Eventually, it will be dependent on what the case facts are and what the insurer appetite would be with respect to that particular risk.
I think we'll take up the next one by Anjali, which says, can we obtain a WNI policy for known losses or claims? So during diligence, if the buyer may know about a loss or a potential loss, will a WNI still cover for these?
Yeah.
And
Yeah, I mean, on a fundamental basis, the WNI policies will cover unknowns
Yeah.
effectively. So that's not what the policy's there to do. But we've been talking about tax policies and contingent risk policies, and they're the sort of products that can respond to known matters. And that is much more on a bespoke case-by-case basis.
Yeah, so
No matters that have a contingent outcome.
Yes.
In terms of the outcome is not fully known and hinges on
Exactly.
on a legal opinion or a
Yeah,
Yeah.
that's right. I think to answer the direct question, I think it would the answer is no. The idea is to cover, as you said, only unknown risks, and the known issues are generally classified as an exclusion in the policy itself. Moving to the second one from Anjali again, which is, if a buyer has not done any diligence on a particular area, example cyber, will a WNI cover such area?
I'm happy to take this one
Sure.
in the first instance. Generally speaking, no. We're looking to sit behind a diligence process. So we expect the buyer to have done a level of diligence to verify warranty. What I will qualify that by is we appreciate that in any sort of everyday transaction, you can't turn over every single stone and go down to the most minute detail. So that's why we have sort of de minimis thresholds and retention thresholds to help with that. So to the extent that something has been left out of diligence because it is not material for that deal, noting the size of a deal, we can sort of have a discussion on that and look to cover if the de minimis is going to be relevant to sort of take that risk away. But principally speaking, and in the fundamentals of it, diligence should be done on all areas to obtain cover.
I think just adding to that, it also depends, something that can be taken into account is what sector you're looking at, right? So materiality for cyber may be a little bit low if you're looking at a manufacturing entity.
Yeah.
So I think that, there is some level of practicality and understanding that goes into it. But yes, obviously, we would expect, a certain level of diligence to be done. I think insurers expect a certain level of diligence to be done, especially with respect to the material areas of that business.
Yeah, but I think increasingly as we're insurers getting more comfortable, with the Indian market and the product, I think that definitely we look to be commercial and to be sensible, because ultimately, we're essentially sitting above what we would think is a really market standard reasonable diligence process, and that will vary differently from depending on the target's operations. Yeah.
Agree. I think we'll take up the next one by Deep Waghela. Would like to know at what point in time WNI insurance policy should be taken, at the time of LOI or execution of the agreement, or post-closing when? So I think to that point, and I'll, you guys can add on, I think the idea is to start the discussions with the insurer and rope him in the process as soon as possible, clearly prior to execution, so that the diligence and the timelines can be embedded in along with the execution and the closing timelines.
Yeah.
Anything that you want to
Yeah.
add?
Perhaps I can add that, from a process perspective, insurers are fine to have the policy separated at signing, post signing, at closing, maybe perhaps post closing as well. It'll all depend on how dated your diligence will become when you
Yeah.
get your policy incepted. And therefore, ideally, if we were to talk about an ideal situation, we should be starting the process whenever you have your draft SPAs ready. This will also help you in getting feedbacks on the warranties which are being currently drafted. Insurers will give you comments on what's covered, what's not covered. If nothing else, it will help in your negotiation. It'll also give you a good sense of what gets covered, because I'd be lying if I say you get 100% coverage of every reps and warranties in the SPA. And therefore, it'll also boil down to the fact on whether you have indemnity in that transaction or not. Because if you don't, then you ideally would want to have the policy in place at signing before you sign the dotted line in the transaction. So it's a customized bespoke product. Eventually, there is no right and wrong way of when to do it. Earlier the better, so that it is in your benefit to get maximum feedback, maximum coverage that is possible. But eventually, and therefore the general long and short of it is that you should look to speak to us, to the insurance company, as early as possible to get an initial feedback on your transaction.
I think the next one is, what does WNI cover? Does it cover normal accounts up to March 31st, or does it cover management? I think we discussed this in in the course of our sessions. Alex, you remember?
Subject to diligence, you can cover both, right? Now, the management accounts should be drawn up to a period before signing so that they can be finalized and subject to diligence. So generally speaking, that's maybe a month or two before the signing of the SPA. And that will cover the period between 31 March. Now, they're not going to be covered to the same standard because they're not going to have been audited to a true and fair standard like they would in the audited accounts. But there is still cover for warrant, something like it doesn't, these accounts do not materially misstate, the assets and liabilities of the business. So we can look at that, but provided there's been diligence by your financial advisors into those, they can be covered in addition to the 31 March accounts.
Mandira, you want to take up the one by Somil? In terms of an Indian company allowed to take insurance on tax warranty as well as business WNI in India and outside India?
Again, it boils to the point of wherever the insured is, we will have to structure the policy in which is compliant with the regulation of that particular country. And therefore, an Indian company, if that's the buyer, if that's the party which is being insured, then we need to place that policy within India. India is an admitted market, which means that the Indian regulation doesn't allow us to go outside of India. But again, as a broker, we can structure that to get you maximum coverage for both tax warranties and other business warranties in the SPA as well.
Sure. By Sujal, which is, please can you talk to claims experience and payments made in the Indian market?
Covered that as well.
Yeah, we've briefly covered this actually in our discussion. I don't think we'll have specific data points to add with respect to the India market.
It's important to note that obviously claims are confidential.
The
way in which these are done are directly between the insurer and the insured, and so they're not subject to a court proceeding where there's information out there. They are confidential settlements. So we do talk about claims in a general sense, and everything we've said is true for global and India.
And India.
There's no difference between what we're seeing in terms of the notifications that are starting to come through, the types of claims, the nature of the claims. There's no difference from the global, which has a greater claims experience due to it having had a maturity for a lot longer.
And claims are obviously a lagging indicator of policy count. So I think that the number of policies placed in India has sort of exponentially increased in the last few years. So I think the claims experience is following naturally from that. I've discussed it, a large tax claim, for instance.
I think there was one question around tax being covered as a fundamental warranty. No, that's a separate bucket altogether. You have 3 buckets typically in an SPA, but tax warranties do get covered under the WNI policy within the tax, within the tax warranties per se. They don't get covered under fundamental warranties. But
actually for a longer period than in fundamental, we'll cover for what
some of this tax warranties.
Yeah, so 7 years from the end of the financial year in which closing occurs. So it's actually beneficial that
get them covered as a tax warranty rather than other fundamental. The fundamental reps are covered for 7 years from closing of the transaction, versus the tax reps can be covered for 7 years from the end of financial in which the closing happens. You get that additional few months so that you get covered adequately from a statute perspective.
Also, 281 is generally structured as a seller fundamental.
As a seller fundamental,
correct.
yeah.
Correct.
I guess that question could also be talking about in terms of in the context of fundamental top up. And we have seen that some
Yeah.
people take higher limits for their tax warranties. So
Correct.
yeah, that's available in the market too. Maybe not to the extent of fundamental in terms of the capacity available, but
But
definitely
for the top up.
you can get some additional cover for each of the buckets if you want.
Absolutely. So these are bespoke, deal specific product, which can be customized depending on what the rationale for using the product is and what the risk is and what we're trying to address through the policy. So these can be fully customized.
I think we can close with this. If the participants have any other questions, they can email it to us and we'll be happy to take them up. For now, I think thank you all for joining in, and thank you, Alex, Mandira, Cam, and Radhika for an interesting discussion this afternoon.
Thanks,
Thank you,
Harshita.
Harshita.
Thanks. Thank you very
Thank you.
much.